In this video, I'll help answer the question, is Cal-Maine Foods a good buy? If you don't know who I am, my name is Tepper and I'm the founder and CEO of Tykr, which is a platform that helps people buy and sell stocks with confidence. All right, let's get right to it. We're going to use a process called the 7. It's the 7 key steps to determine if a stock is a good buy, hold, or sell. Before we get to it, I'll show you a quick little tip. If you're interested, you can go to Tykr.com, you can go to education and then down to calculations. If you don't already know this, the calculations in Tykr are open source for personal use. So if you're a math nerd like myself, you can go ahead and play with the calculations in Excel. All right, let's go ahead and take a look at Tykr and we'll walk through the 7. So the first thing we're going to look at is the summary. And I'm going to show you here, this will give you a really nice perspective of our rating system in Tykr. And when I created Tykr over a decade ago, it started in Excel and eventually became a software. I was thinking of, hey, what's the easiest to understand rating system? And I thought, you know what? The traffic light does a pretty good job. So stocks in Tykr are either on sale, watch, overpriced, green, gray, or red. So taking a look at Cal-Maine, check this out. This stock is on sale. This is the first step of 7. So that's really hard to do. Only about 15% of stocks make it to on sale. To get to on sale, you need a score in this hexagon, a score of 50 or higher. And you can see here, this is at 100 out of 100, which is, I did a little research here in Tykr. Out of the 59,000 stocks in the platform, only 26 have a score of 100 at this moment. That's crazy. So this is like right at the top. So you need a score of 50 or higher, and then you need a margin of safety of 50% or higher. Of course, if only one of those hits 50 or higher, then it's watch. And if they both miss 50, then they're overpriced. So in this case, checking 3 boxes in a row, that summary, score, and margin of safety. Next up, 4th step in the process. This is the 4M confidence booster. This is really important. There are a lot of investors out there that only look at the math part of investing. You need to go a step further and also look at the meaning, the moat, and the management. So let's take a closer look at what those mean. If you click on boost confidence, you can see here math, of course, that's the first M. Next M is the meaning. That's the business model. How does it make money? How many revenue streams does the business have, and how scalable are those revenue streams? Then you have the moat. That's how business compares to other businesses in the same sector and industry. And then you have the management. That's the track record of the CEO. I'm not going to walk through it right now, but we'll just go to the next screen. This will give you really good perspective on the gamification of Tykr. You can see here we want to get to a 80 to 100 is high confidence in the stock, 60 to 79 is moderate, and anything 59 or less you probably want to avoid. All right, so closing this, we can see here Cal-Maine is at 90. Getting above 80 is actually really hard to do. So 90, outstanding. Let's keep going. Down below, we have the 5-year returns. Now you can click on these different durations here, but a good number to memorize is 80%. The S&P 500 typically returns about 80% over 5 years, and we like to invest in stocks that consistently beat the market. Not over 1 year, but over 5 years. So we see here 140, that's exactly what we're looking for. Of course, past performance does not guarantee future returns, but again, we like to see stocks that are very consistent year over year. All right, we're almost done. Let's keep going here. Next up, we have the financials. We look at the financial statements. This is Warren Buffett investing. We do not look at charts and graphs. If you want to do that, that's fine, but we invest like Warren Buffett, value investing, so looking at those financial statements. There are the 3 statements, the income statement, cash flow statement, and balance sheet. On the income statement, we have revenue, net income, and EPS. On the cash flow statement, we have free cash. And then balance sheet, we have assets, liabilities, debts, and equity. Out of these 8 lines, you want to see 6 of them increasing quarter over quarter, and then you want to see 2 of them decreasing. The 2 you want to see decrease are liabilities and debts. The biggest liability in a business would be payroll. Ideally, you want to see that flat. If you increase your revenues, a good business will try to keep their payroll the same. If it's decreasing, that means you're maybe cutting headcount or cutting other major expenses in the business. Then you have debts, that's just bank bank loans. So ideally, you want to see businesses paying off their debts. All right, so taking a look here at Cal-Maine, the numbers are really looking good. The last 2-3 quarters, they're kind of falling off a little bit, but in general, they are better than the previous quarters. So I'm just taking a look here. This is not a huge red flag, but it is something to pay attention to. But the number one most important line we're looking for, it's not revenue, it would be EPS, earnings per share. Essentially, that's net income divided by outstanding shares. In other words, it's the profits of the company. Are the profits increasing or decreasing? So we can see here, we're seeing a decrease. It's still much better than previous quarters, but this is something to pay attention to. There is a decrease happening as we speak. Not the end of the world, but worth paying attention to. We'll talk about why this is happening in a second. All right, the last thing we're looking at would be the earnings calendar. When you have a business that's increasing its profits, this is key point one, it's increasing profits, and two, it's beating those earnings estimates in most cases, not all, but most, the share price typically goes up after those quarterly earnings reports. Now you flip that equation, let's say you have EPS that's dropping and at the same time they're missing their earnings reports, that's when share prices, in most cases, not all, but most share prices can go down. So we see here they're beating their earnings, which is great, but EPS is going down, and we're going to get to the share price here. What's happening here? We're going to answer the question, why is it going down a little bit? So if we go to the 7, this is the easy button. We did the manual way, but if you go to the 7, I think we're going to get a 6 out of 7. 5 out of 7. Okay. So ideally, you want to find businesses that are 5 out of 7 or higher. So this does check the box. But is this a business I would invest in? Well, let's answer that question right now. If you go to this screen here, looking at the chart, you see this massive decline. In fact, let's go to the 3-month chart. We see here they go from about 116 down to 92. So we can see here over the last 3 months, it's down about 8%. Well, the reason the share price is decreasing is because of the profits are decreasing. What happened a few years ago, there was the avian influenza. What that created was a shortage of eggs. You have lower supply, which means prices increase. Well, now, ever since, we have greater supply, so that means the prices per eggs, or for a carton of eggs, that is now decreasing, which is creating lower profit margins for the business. So it's great for us out there who like consuming eggs. We can buy eggs at a cheaper price, but is it good for Cal-Maine? The answer is no. Now, is this the end of the world for Cal-Maine? I would say no. Eggs will always be in demand, and they're one of the top players for eggs here in the US. So overall, is this a business I'm going to buy, hold, or sell? Well, in this case, I like businesses that have a lot more revenue streams. And although I like the business, I like eggs, but from an investment standpoint, I'm going to keep this one on my watch list. I'm going to keep it in holds. And with the returns here, 141, if the S&P is returning about 80%, I'm expecting in this case, this might be a market matching stock. I don't really see it falling to single digit returns, but 80% returns over 5 years is probably what I expect of this stock. If I'm looking for some stocks that can accelerate my wealth building process, in other words, I can make more money in less time, I would probably look for a lot stronger stocks in the market. To give you a quick pro tip and we'll wrap up. If you go to assets, stocks, I'm going to show you the filter here for the 7. We're going to find some other options, you could say. So we're going to go ahead and make sure this column, the 7, is turned on, which it is. We're going to put it in the order that I like. You can drag this to any order you want. But I've got company, summary, score, margin of safety, 4M, and 7. That's what I like to see in that order. Let's go ahead and do this. This will give you a nice short list generator if you want to find some strong stocks. Let's go to 5 out of 7. You're going to see this 59,000 turn into about 1,000. Let's go to 6 out of 7. That'll give you a nice short list of 231, and 7 out of 7. There you go. Only 21 stocks get that high. And if you look here, 5-year returns, these are some solid returns in the market. So Cal-Maine, good company, good products. Again, I like eggs, but from an investment standpoint, not something I'm going to invest in this moment. But if you use Tykr, you can probably find some much better ideas in the market. If you want to see the latest scores on Cal-Maine, you can join Tykr for free. Some other benefits of Tykr include knowing when to buy and sell stocks. You can also see my portfolio. And in most cases, you can sync up your broker to Tykr, so your Tykr portfolio tracker is updated every day. Of course, don't buy and sell stocks based solely on what you hear. Only buy and sell stocks that align with your own personal financial goals. Thanks for checking out this video. We'll see you in the next one. Bye for now.